Hey guys, Mr. Tweet here. So in this video, I'm going to be going over kind of the Fed and how they shift the supply of money. But first, I just briefly wanted to kind of go back to our money market graph here. And the idea of the money market graph is that there is, in the economy, there's this general interest rate that based on the amount of supply of money of M1 at any given moment and the demand for M1, that there's a general interest rate that you have to pay when you want to borrow or you get to collect when you lend money. Now, some things might be riskier loans, some things might be less risky loans. The government might subsidize some loans like student loans or home loans. Other loans might have some collateral attached to it. So like if you get a car loan and you don't pay it, they could take the car away. Other loans are unsecured, so there's nothing backing it up, so they're more risky. So depending on like the level of risk because of the type of loan or the borrower, like whether you have like good credit or bad credit, all of those factors determine what interest rate you actually pay. But behind the scenes, there's this idea that there's a general interest rate and all those other interest rates are connected to it. So that another factor is how long the loan is. So a 5-year loan versus a 30-year loan, there's going to be different interest rates, whatever. But that behind the scenes, there's this general supply and demand of money, and that determines that general interest rate, right? So what the Fed does is the Fed changes the supply of money to try to change that general interest rate so that they should see interest rates going up or going down based on their actions. So that if you're the Fed and you increase the money supply, then what you should see here is the general interest rate would fall. Now, that's going to mean different things for different types of loans. So that like when it comes to like a credit card rate, it might not change very frequently. They have to send you out new paperwork telling you that the rates have changed on your credit card, so that if there's a small change to the general interest rate, credit cards might not change very much. Your home loan might change, the rates that banks are offering for home loans, that might change though. If there's a change in the general interest rate, we might see that. Now for a home loan, because it's over 30 years, it's probably not going to change a whole lot compared to the change we see here. Whereas a more short-term loan, like a car loan, which is only for 5 years, it's going to be, it's going to change more quickly with that. So different loans have different effects. The Fed, they look at the federal funds rate to see what the effect of their change to the money supply is. So they look at this one rate that's a really short-term loan. It's a one-day loan from bank to bank. So because it's a one-day loan, it changes like that when there's a change to the general interest rate. So that's what they look at to see like what's going on if we change the money supply, what's happening to interest rates. They look at that federal funds rate to see what's going on. The tool that they use most frequently to change the money supply, though, is buying and selling bonds. So you really have to understand how this works. That the Fed is really an entity that is outside of the economy. So if we think of the economy, right, as this, the Fed is something outside of it. And the Fed, when they're buying and selling bonds, what's happening is they're putting M1 and M2, they're moving it in and out of the economy. So that when the Fed sees a recession happening, they want to put money in, right? M1 money into the economy. So the way that they put M1 money into the economy is what they do is they buy bonds. So money is going in and bonds come out, right? When we have a recession. So that does is that money going in increases the M1 quantity, it's decreasing the M2. But M2 doesn't have any effect on these interest rates. These interest rates are based on the demand for M1 and the supply of M1. So what's happening here, supply of M1 goes up, interest rates fall. And then if they want to raise interest rates because the economy is getting too hot, they just do the opposite thing. Instead of buying bonds, they sell bonds. So when they sell bonds, bonds go into the economy and money comes out and interest rates go up. So last thing you need to know is when we do this buying and selling of bonds, that the effect on the economy is bigger than the dollar value of the bond itself. And we use the money multiplier to figure that out, so that we would have, when we do have the Fed buying and selling bonds, what you end up with is the total change to the money supply. The total change of the money supply is going to equal 1 over the reserve ratio. That's the rate at which banks save the money. They're forced to save the money that's deposited with them, times the amount of the individual bond. So that if it was a $5,000 bond, and if the reserve ratio is 10%, then our multiplier is 10. So it would be $5,000 times 10, $50,000 change to the money supply. So that's the Fed and kind of, the idea of interest rates and how all interest rates are connected to this, to kind of the general supply and demand for money, which leads to this thing that we call the general interest rate, that as general interest rates go up or go down, all other interest rates should go up and go down as well, which then affects aggregate demand. So that's how the Fed changes the money supply to kind of ultimately affect interest rates and finally change aggregate demand, changing GDP. All right, you guys have a good one. Peace.